So our today's topic is the cost of capital. We are still talking about investment projects valuation. And last time we have discussed the important step in that process that was about building the cash flow forecast or estimating cash flows. Um, when you want to apply any of the investment project valuation methods like NPV, stability index, modified internal rate of return, you need another element that is also important for doing this. And this is the required rate of return. All the previous classes, we assumed that this required rate of return is given, and you make a discounting with the help of that rate, but we haven't said a word about the source of this information. So I hope you see the whole picture of our path. So we started with the methods of investment project valuation, payback, NPV, IRR, modified internal rate of return, and so on. We discussed their limitations. Then we made one step deeper into the question of cash flow estimation, how cash flows for this NPV and other things are obtained. And now we are doing the second step, how to obtain the interest rate for those computations. And in the case of investment project, the required return is called the cost of capital. So if you want, these are the synonyms. Required return, cost of capital, but usually when we are talking about investment project valuation, we call this interest rate the cost of capital. Why do we call this the cost of capital? Because if a firm thinks or plans to implement the investment project, it needs money initially. We have seen that everything starts with the initial investment outlay. You need to purchase machinery, equipment, land, something else, buildings. You need to make investments into the inventories, probably. For this, you need money. And there are several sources of money for the investment projects. And we know them. We know them from the other side. We know them from the side of investors. So we know that, for example, money can be given to the firm with the help of debt. Investors either purchase bonds, or maybe banks can give loans to the firm. Both are called debt issue. Again, we did this, we know this. We discussed this from the other side of those relationships. Now we are talking from the side of the firm. But before, it was in the lecture number 4, we discussed the problem of bond valuation from the side of investor. Now we are on the other side, on the side of firm. But we are talking conceptually about the same thing. Nothing new here. What else we have discussed during that time? We discussed that on the other side, investors can provide money to the firm with the help of buying preferred stocks or common stocks. Then for the firm, these two are gonna be sources of capital for investment projects. And again, everything that we are gonna discuss today is gonna be built on the discussions in lecture 4 and lecture 5 about stock and bond valuation. So, and we know from those lectures that investors who provided the funds, they expect to receive a return on their investments. We had an interest rate, RD in the case of bonds, RS in the case of stocks, in order to estimate the acceptable price, present value of bond, present value of stocks. That was the acceptable price. If investors require some return from the firm must provide this return to them. And for the firm, this becomes cost. If a firm pays to you something, this is the return for you, but this is the cost for the firm. Again, we are talking about the same thing, but we are talking about this from different sides of the relations. If I pay money to somebody, for me it's cost, for that somebody it is the return. I hope everyone understands what we are talking about. And then if a firm uses several sources, so the average of the component cost is the cost of capital. So that's the logic. How do we compute the cost of capital? Now we will discuss the individual approaches to each of these components. So to the debt, to the preferred stock, to the common stock. We start with the cost of debt. Again, the cost of debt for a firm is the rate of required return by debt holders. We know from lectures 4, I believe that was lecture 4, that investors evaluate bonds according to the following formula. So this is how investors compute the maximum acceptable price. Now we turn this upside down. We say, well, from the firm's side, PV is known. The firm knows how much money does it need to borrow. So the firm knows PV. And this is going to be the market value of debt. So how much a firm can raise from the market if the firm issues bonds. What the firm does not know is RD, this interest rate. So the cost of debt is RD from this thing. And instead of PV, we put here PN. What is PN? PN is the market price of a new bonds issue less the flotation cost. So what is the flotation cost? I guess it is obvious that any firm that wants to issue new securities, bonds or stocks, needs also to pay something for this. There are some intermediaries, underwriters, stock exchange, bank, whatever. There is a huge documentation connected to the securities issue. So all those costs are considered the flotation costs. And of course, the firm receives less than the market price of the bonds. The firms receives this market price minus flotation cost. Again, the problem is to compute this RD from here. And this is very similar to the computation of internal rate of return in the investment project valuation. Why? Because we have some kind of polynomial here, and we need to solve this equation. This equation is very difficult to solve, so that's why probably we need to apply the same methods as we did in investment project valuation. Now, an additional thing here. For investment valuation, RD must be the marginal cost of new debt. It is not the average, it is not the historical one. This is very important. We are talking about the new debt. So since we are talking about investment valuation, an investment project is going to be implemented, so this is about future, we also want to know the interest rate on the future debt issues, not about the past ones. The past ones might be different. So this is important conceptual thing to understand. And the final step related to the cost of debt is debt provides an additional tax benefit because interest is the tax deductible. We have seen this last lecture when we spoke about interest expenses and why they are not subtracted from the cash flow when we estimate investment, when we evaluate investment projects. And due to these tax benefits from the interest, we also reduce the cost of debt by the tax rate according to the following formula. It provides additional tax benefits for the firm. Next component, preferred stock. We haven't said much about preferred stock in the lecture number 5, and we need to highlight several important features of the preferred stock here. So usually firms pay dividends on preferred stocks. So I hope you remember that on the common stock, it is about the decision of the board of directors whether to pay dividends or not. So a firm might decide to pay, might decide not to pay, but for the preferred stock, usually firms do pay dividends, and that's why. So first of all, if a firm does not pay dividends on preferred stock, they cannot pay dividends on the common stock. It is forbidden to pay dividends on the common stock before preferred stock. So that's why preferred. If a firm does not pay dividends on preferred stock, a firm may face some difficulties in the future to raise additional capital. So if the firm needs more money in the future, nobody would trust them. They would say, well, you failed to pay dividends on your preferred stock, We don't want to provide you money. Very simple. The third reason that preferred stockholders, in some cases when the dividend is not paid, they can also take a control over the firm, which means that they would have the same right as the common equity holders. And in some cases, this is not what a management wants. So, due to these reasons, firms usually pay constant dividends on preferred stocks. Yeah, so we assume constant, indefinite stream of dividends on the preferred stock. And we know from lecture number 5 that if there is no growth, then investors evaluate a stock. Investors compute the maximum price acceptable to pay. According to the following formula, we just divide dividend by the required return. Now we are talking about the firm side. And from the firm side, we know how much money do we want to receive from the preferred stock issue. We know how much dividends we are ready to pay. What we don't know is the interest rate, so we need to turn this upside down again. We need to express interest rate, which is now the cost of preferred stock, from the following formula. And again, PN is the market price of a new preferred stock issue less the flotation cost. Very important that this is not a price itself. This is the expected price in the future minus whatever it costs to issue this preferred stock. Preferred dividends are paid from the net income. Those are not tax deductible. They don't affect taxes. So therefore, no tax adjustments are needed. Simply leave it as is. The third component, equity. Companies can raise common equity in two ways. So first, if they directly issue new shares, common shares. Not many companies do this. It is very rare case when firms issue new shares. You have probably heard of several companies who issue new shares, but every year there is a limited number of such companies. More common practice is when firms indirectly increase their common equity by retaining earnings. So they are not paying dividends to the stockholders, or they are not paying the whole earnings in the form of dividends 100%. So they are paying some part of earnings as dividends, and some part of earnings is retained, increasing common equity. Now the question is, we are speaking about cost of equity. Does retaining earnings have a cost? Well, it seems like nobody requires the return on retained earnings. Why does it have a cost? The reason is very simple and logical. If earnings are retained, those are not paid in the form of dividends. So the stockholders face an opportunity cost. What is this opportunity cost? The earnings could have been paid as dividends, and stockholders could use this money, for example, by reinvesting them in some other investments. And the firm should provide at least such return that stockholders themselves could earn on some alternative investments. So if you as a firm are not paying money to your stockholders, then you need to have some solid reason for this. And the solid reason is when you claim, well, dear stockholders, we know that you are able to invest this money with, let's say, 10%, but we would retain this money and earn 15%, which is more. We have more opportunities. Maybe for you as stockholders, this would be beneficial. And probably stockholders would agree, because it is definitely better to earn 15% versus 10%. This is very simple logic. Now the question is, how do we know this? How do we know the opportunity cost? And the answer is simple. There are three different methods, and one of these methods is known for us already, which is the discounted cash flow method. We know Gordon growth model from the lecture 5, and this Gordon growth model is exactly what we use here. But there are two other approaches. One is very popular approach called the capital asset pricing model method. Sometimes it is given as a shorthand CAPM. And the third is the bond yield plus risk premium method. Not very frequent, but also has some good properties. So let's start with the DCF approach. We know from lecture 5 that investors evaluate common stock according to the following formula. So there must be equal sign here. P0 equals D1 over RS minus G. From here, we express RS. So RS is D1 over Pn plus G. Again, what is Pn? Why not P0? Because Pn is the market price of a new common stock issue less the flotation cost. So we are talking about different things. P0 is the price investors pay. Pn is the money a firm receives, minus everything that a firm needs to spend. Very simple. This is one approach how we can establish the cost of equity. The second approach, we haven't said a lot about this during the course. I did it on purpose. If you are interested, you can Google about this CAPM thing. Maybe you can watch some video. I also have description of CAPM on some other classes. We have several steps in the CAPM method. So we need to estimate something which is called the risk-free rate. We need to estimate something which is called expected market risk premium. And we need to have a measure which is called beta coefficient. And then we just mix these things. So the required rate of return on the stock is this sum. Risk-free rate plus market risk premium multiplied by beta. What are these things? Usually, risk-free rate is the rate on long-term government bonds. So how much you can earn if you purchase long-term government bonds. Risk premium is the difference between expected market return, so how much market would change, minus the risk-free rate, already know. So beta is the measure of sensitivity of the company's stock returns changes to the market return changes. I'm not going to discuss the technicalities of this beta coefficient computation. You need to simply know how the model looks like, and you need to understand at least the conceptual things, what each of these three elements mean. This is the rate on long-term government bonds. This is the difference between market return and risk-free return. And this is some coefficient of risk, beta coefficient, coefficient of risk, or coefficient of sensitivity of the risk of the stock returns to the market return changes. So this is CAPM approach. And the third approach is rarely used, as I said. In some cases, when you are not able to apply either of the two methods, you apply this bond yield plus risk premium approach. This is subjective approach. And the logic is to take the interest rate on the firm's long-term debt, which is RD from one of the previous slides, plus risk premium 3 to 5%. Maybe more, it depends on the country. It is not a rule. As I said, it is some subjective approach just to approximately estimate the equity required return if there is no other approach available and possible to apply. So the cost of equity here is estimated as the sum of RD and some risk premium. As I said, 3 to 5% depends on country. Now, when we know cost of all three components, debt, preferred stock, equity, and when we are able to evaluate each component's cost, we need to collect this in one measure. And this one measure is the weighted average of these various components costs. So we call this weighted average cost of capital. So the weighted average cost of capital, how it is computed. We need to know the total monetary size of debt issue, preferred stock issue, and equity needed for the investment project. So basically this, the denominator of each of these three fractions would be equal to the investment outlay. Then we take each of the components, divide by the total amount of capital. So what do we have? We have weight. This is y weighted. Then each weight of debt, weight of preferred stock, weight of equity, multiplied by the cost of the respective component. Weight of debt multiplied by the cost of debt, weight of preferred stock multiplied by the cost of preferred stock, weight of common stock multiplied by the cost of equity. And this is what we have as the discount rate for the further computing net present value, profitability index, discounted payback, or modified internal rate of return. And also we compare internal rate of return with this measure, with weighted average cost of capital. So this is the whole procedure. How do we estimate cost of capital for the investment valuation purposes? And the important conceptual thing here, that the correct weights, these, and these, must be based on the firm's target capital structure. What does it mean? It means what the firm is planning, what kind of capital structure the firm is planning to have in the investment project. So how much percent is gonna be debt, how much is going to be preferred stock, how much is going to be common stock. For example, if a firm wants to fund its investment project with 70% of debt, 10% of preferred stock, and 20% of equity, then it's going to be 70% here, 10% here, 20% here. So with this, we somehow conclude the huge topic of investment project valuation. We had 1, 2, 3, 4 lectures about this. We started with the NPV and other investment criteria. Then we discussed what are the problems with internal rate of return in the case when we need to decide between two projects, and why net present value is preferred. And also we suggested the modification of internal rate of return, which can be used for those who prefer interest rates over some monetary values. So the last lecture was about estimation of the cash flow for the investment project, and today we conclude with the approaches how we come up with the cost of capital needed for NPV and for other investment criteria. So as it was said, for investment projects, the discount rate is the weighted average cost of capital. And the methods for estimation cost of capital, so don't think that this is something new. Those are based on the bond and stock valuation methods that we discussed before in this course. So we will take an example and we will try to apply these methods to the practical example from the book. So this is the book of Brigham and Erhard. And so we have a huge setup for the case study. But let's try to extract the information that is really needed. So during the last few years, Cox Technologies has been too constrained by the high cost of capital to make new capital investments. Recently, though, capital costs have been declining and the company has decided to look seriously at a major expansion program that had been promoted by the design marketing department. Assume that you are an assistant to Jerry Lee, the financial vice president. Your first task is to estimate Coke's cost of capital. Lee has provided you with the following data, which he believes may be relevant to your task. The firm tax rate is 40%. Okay, so this is somehow relevant. We need somehow the cost of capital. For the cost of capital, we need the interest rate. So let's start writing down what is given for us. So T is 0.4. Then what do we know? The current price of Coke's 12% coupon semi-annual payment non-callable bonds with 15 years remaining is la la la. Coke doesn't use short-term interest-bearing debt on a permanent basis. New bonds would be privately placed with no flotation cost. So the second part is something about the cost of debt, right? So for the cost of debt, we have the following data. We know that, so the coupon is 12%. We know that there is semi-annual payment. The maturity of these bonds is 15 years. The price P0 is 1153.72. And no flotation cost. And we also know that those are semi-annual. So with this data, we are able to estimate the cost of debt. Let's go to the lecture slides and let's see how do we do this. So first of all, since there is no flotation cost, so Pn is gonna be equal to P0, which is 1153.72. Good. What else do we need to know? We need to know interest. Interest is what? Is 12% multiplied by the face value. Do we know face value? Probably no, but well, I assume that there is 1000. Must be. Yeah, okay, so assume that M is 1000. But also we know that these are semi-annual bonds, so which means that we need to divide this by 2 times a year. Overall it's 60. Now RD is not known, that's what we are looking for. And M, as I said, is assumed to be 1000. N is gonna be recalculated as 30, but well, we can adjust it basically. So now our formula would look like 1153.72 equals to interest 60 times 1 plus RD divided by 2. Again, we are talking about semi-annual coupons, therefore we divide annual interest rate by 2, and to the power of n, but n is not 15 years, n is 30. So again, 15 times 2. minus 1. For those who forgot about bond valuation, welcome back. We still need this thing. So here and here divided by 2. This is the denominator plus 1000 divided by this. So this is the equation, and from this equation we need to express this RD. We have two options. First option, as for internal rate of return, we can use interpolation. So find two interest rates such that, so first you will have the left hand side, so right hand side is less than left hand side, I would draw like this, and right hand side is going to be greater than left hand side, and then as we have this computed internal rate of return with the help of proportion, you can use the same here, use the same approach. There is not much time for this. I guess we can use the second approach, so use Excel. So let's try, or maybe we can use both methods. Depending on time. So the Excel formula, we compute it in the following way. So we need to have the whole time, simplest approach, let's say, the whole timeline. This is our cash flow. We start with the negative 115372. Again, why this? Because we are talking about, so this is investment, right? So we need to pay this in order to obtain this afterwards. So 60 every 6 months up to the 30th period, and in 30th period we have 1060. So RD is going to be internal rate of return of this stream. It's not RD, it's RD over 2. So from here, RD is this multiplied by 2, which is 10%. Okay. This is one option. How we can simply, effectively compute RD, 10%. Another option, RD. If we have, so this is price 115372. This is coupon 60. This is the face value. 1000 and periods equal to 30. We can apply something like yield, if I remember this correct. Let me see. Let's try. I don't remember how this formula works, but it definitely should work. So settlement, maturity, 30 periods, rate. No, probably we need to have some help. What is this? So financial formulas, yield. Yeah, yield to maturity. So settlement is a security settlement date expressed as a serial date number. Yeah, we need to have some dates here probably. Security maturity dates. No, probably this is not gonna be a good idea. No, this is when you have the exact dates, like in the real practice. So probably this is not gonna be a good idea. But okay, so let's try the first approach with the interpolation. So what is gonna be the left-hand side? This is gonna be always price. So right-hand side. Right-hand side, we need to take two interest rates. So for example, take 5% interest rate. So R1 is gonna be 5%, and we would calculate right-hand side if there is a 5%. So this one. We have coupon times 1 plus R to the power of divided by 2 to the power of periods 30 minus 1 is taken divided by 2 multiplied by 1 plus divided by 2 to the power of periods. So this is the first part, plus 1000 divided by 1 plus R. And 1000 can be taken from the face value. Divided by 2 to the power of here. Okay, seems like we have 1732. So with the Excel we have this. With this, take R1 equals 5%. So the right hand side of 5% equals 1732.56. Okay, so we need to take another interest rate which would give us the opposite situation. Right hand side is less than left hand side. So we need to take some huge, for example, 15%. R2 is 15%. R2 is 15%. And now we compute right hand side of 15%. Simply copy it here. Something has been put. I failed fixing this. No, still wrong. Why? Ah, yes. I also need to fix this. Coupon payments. Yes. So now right hand side of 15% is 82284. So now again, this is simple reasoning proportion. So when R changes from 15% to 5%, right hand side changes from 82284 to 173256. We want such change in R that right hand side changes from 82284 to 115372. So they must be equal to each other. And we build a proportion. So the proportion is simple, 15% minus 5% divided by the 82284 minus 173 must be equal to 15% minus RD, whatever we need to compute, divided by 82284 minus 115372. So from here, RD is approximately equal to, because again, it is not exactly equal, we approximate, the computation is approximately equal to 15%. Let me think. Multiply this thing. Multiply this thing. Okay, so we can rewrite it like this. We have this from the denominator divided by this. Multiplied by this difference. On this side. And then we need to flip the signs because it's minus RD, it's 15%, so we have something like 15% minus this, isn't it? Let me think. So we move it there, so it's negative, then we switch the signs. Yes, it must be good. So what is RD approximately according to this approach? 15 minus 5 multiplied by the difference of this minus this divided by this minus this. It shouldn't be exactly 10%, of course, as I said, it is going to be approximately 1136. But look, if you take interest rates closer to each other, so for example 8% and 12%, you see that RD is going to be closer to the correct answer. So if you take like 9 and 11, for example, it's going to be even closer. So that's why it is important to take these interest rates as close to each other as you can. Okay, we have a cost of, so finally, cost of debt is, we can take this one, 10%, and then we don't forget to multiply this by 1 minus tax rate. We know that the tax rate is 0.4. So it's 1 minus 0.4, and finally we have 6%. This is going to be after tax debt rate. Now we go back to the task. Part 3. The current price of the firm's 10% 100 par value quarterly dividend perpetual preferred stock is 113.10. Cox would incur flotation costs of $2 per share on a new issue. So this is about cost of preferred stock, and we have the data that this is 10%. So D for the preferred stock is going to be 10% of $100 par value, so it's $10. Then we know that the par value, which is not basically needed for us, is 100. Quarterly dividend perpetual preferred stock, so quarterly dividend doesn't matter so much here again, and we know that P0, so the price of this dividend is 111.10 or 113.10, sorry, and we know that the flotation cost, let's call them F, is $2 per share. So from the lecture slides, we know that in order to estimate the cost of preferred stock, we need to do the following steps. It's RPS equals to $10 divided. Now PN is the market price less the flotation cost. So market price is 113.10, flotation cost is 2. So finally, we have how much we have. 10 divided by 111.10, which is multiplied by 109%. Very simple task related to the preferred stock. Part 4. Cox common stock is currently selling at 50 per share. So cost of common stock, highlighted somehow. Isn't it? Cost of preferred stock. P0 is $50 per share. Last dividend D0 is 419. Dividends are expected to grow G at 5% rate. So this is for one approach. The other approach is Cox beta is 1.2. The yield on T-bonds is 7%. So the yield of T-bonds is the government bonds of the United States. So that's why we are talking about risk-free rate, which is 7%, and the market risk premium. So risk premium of the market is estimated to be 6%. For the bond yield plus risk premium approach, the firm uses a 4% points risk premium. So risk premium is 4%. So with DCF, cost of common stock is, let's go to the slides and let's see how do we do this. With the DCF, do we have anything about flotation cost of new stock? There is nothing about it. Okay, so then we can probably forget about flotation cost here. RS with DCF D1. So what is D1? this is the last dividend plus growth, which is 419 times 1.05. This is our future expected dividend, and we divide this by PN, which is the price, $50 minus, if there is any flotation cost, then we would reduce it, plus growth rate 0.05. So we have 419 times 105 divided by 50 plus 0.05. 13.8% with CAPM. Return on total cost of equity is RF, which is 7%, plus risk premium 6%, multiplied by beta, which is 1.2. So 6 times 1.2 plus 7, so it's 14.2%. Finally, with bond yield, we know that RD is 10%. Here it was estimated. 10% plus 4% risk premium, so we have 14%. So all three methods give us more or less similar answer, and usually in practice there is no one specific method for estimating cost of equity. We may get different answers here. So finally, weighted average cost of capital might be calculated with the following information. We have target weights. So the weight of debt is gonna be 30%, so 0.3. The weight of preferred stock is 10%, and the weight of common equity is gonna be the rest, 0.6. Right? So weighted average cost of capital is 0.3 times this 6%, right? So times 10% times 1 minus 0.4 plus 0.1 times 9% plus 0.6 times, so one of these. For example, 13.8%. That's gonna be the final answer that is gonna be used for investment project valuation. So 0.3 times 10 times 0.6, we have 1.8% plus, so this is 0.9%, and this is 0.6 multiplied by 38, 828%. So overall we have 10.98%. So this is the interest rate to be used in the investment project valuation for calculating NPV, modified internal rate of return, profitability index, and other things. So this is the complete example of what you must be able to do in the next exercise session next Saturday. So you are going to solve such tasks, so I demonstrated you the complete application of the lecture. So thanks for your attention today. Have a nice day and see you next Saturday. First group and second group has the exercise session in 15 minutes. Bye bye.
See you.
Okay.
Bye.